Good morning, everyone. Today is Wednesday, September 21st. I'm Marv Eisen of Timeless Dollar Trading Academy, where I teach S&P E-mini futures trading. And beginning the day, and you should do this every day, begin the day looking at the daily economic calendar. I'm using Market Watch, and today, Wednesday, September 21st, is going to be an announcement-driven day because at 2 p.m., the Fed Chairman, Jerome Powell, will make an announcement on interest rates, and these announcements always move the market. So if you are a conservative trader or you embrace risk, well, you need to know about this 2 p.m. announcement because you either want to be in the market very quickly and make a lot of money or lose a lot of money quickly, or you want to sit on the sideline, which if you are risk averse, if you're more conservative, you might want to do that at 2 p.m. At any rate, that's the economic calendar, and moving over to the morning news. And the morning news, now remember, wherever you get your news, you're not going to find any information about where the market is going to go. The market does what it does. And there are various ways or people that purport to tell you where the market is going to go. I use a system that I'll get into in a minute, but nevertheless, nobody can tell you where the market is going to go. Jim Cramer cannot tell you. Maria Bartiromo cannot tell you. Me, I certainly can't tell you, but I can teach you what to look for. And one of the things that you learn when you learn how to trade is the basics of trading, and that's candlesticks, right? Candlesticks. Now, candlestick signals are part of learning how to trade, whether you're trading futures or stocks. But there are candlestick signals that are misleading, and then there are candlestick signals that generally are strong and can be interpreted that the market is going to move in a certain direction. And one of those things happened in the big picture, and I always look at the big picture along with the little picture every day. And this is the big picture of the S&P, not the E-mini. This is the S&P, and each of these candles are daily candles. And typically, we see candles up and down, and this is a pretty big scale so that you can see it clearly. And I want to call your attention to a candle that formed on Friday. And this is the candle right here. You see this candle? Now, there are two things about this candle that I want to point out. And a candle like this, you should always do this if you are looking to be a conservative trader and remove as much as you can any element of risk in order to make a trade that is going to result in a profit. And when this candle formed, remember, this was Thursday, this was Friday. Now, as you can see, this candle is, as you learned in your basic technical analysis courses or books, you learned that this candle is called what? A hammer. Yes, it's a hammer. But let me explain the significance of this particular hammer. This hammer has a real body. This is the real body, and it has a shadow or a tail. Now, there are a couple of things about this hammer that makes it different. This particular hammer has a tail that is at least 3 times the length of the real body, okay? 3 times the length of the real body. That's important. It also forms at the bottom of a decline. You see, here's a decline. Several previous days, the market declined, and it formed at the bottom of the decline. So, A, it is a hammer. B, the shadow is at least 3 times longer than the real body. And C, it formed at the bottom of a decline. So, the buyers are stepping in at this level, at this area. Now, there's something else about this candle that's particularly remarkable, and that is the gap that formed between the prior day's close right here at 3,900, and this candle. Now, this candle is at 3,880. So 3,880 to 3,900, that means there is a 20-point gap or window that formed. Gaps almost always close. Actually, they always close. Not necessarily immediately, but they always close. And so we have a hammer forming at the bottom of a decline. The shadow is 3 times longer than the real body. And there is a gap. This gives me the idea, the strong idea, that the next day is going to be an up day. How much up? I don't know, but I believe it's going to be enough to close the gap. And so let's look at the next day. And here was the next day, okay? This was Monday. This was a Friday. This was Monday. The green candle was Monday. And the market opened, prices opened to 38.50, well below where Friday's candle closed. But nevertheless, where did it go? First of all, it went up, right? It went up from the low to the high. And where did it end? Right at the close of the gap. I didn't care whether this candle closed over here or over here. But my advice to my readers was price closes the gap, end the trade. It just happened to close right at the gap. But nevertheless, this is the target. This was the target. And so if you are a conservative trader, you look for these strong technical analysis signals like this beautiful hammer that informed as to where the market is going to go on the next day. And the next day's trading was almost a gift. It was a gift, actually, because the indication was so strong that this was going to result in a following day that is going to be to the upside, and particularly where the upside has the opportunity to close a gap, okay? So that is the big picture. Now, looking at the little picture, I use technical analysis, but I also use trade setups. Trade setups derived from technical analysis. And in my course at Timeless Dollar, I teach 6 trade setups. Now, I know, you might have taken a course and you might have seen hundreds and hundreds of videos that tell you about flags and pennants and all this stuff and that kind of stuff. There is not that much to know about technical analysis in terms of price setups. There are only 6 trade setups that you need to know, in my opinion, and that I teach at timelessdollar.com. And that's GST TMC. Gap, support and resistance, time and price, trend, momentum, and candlesticks. Those are the only 6 trade setups. And each trade setup, except for the momentum trade, each trade setup is derived from an observation of candlesticks, which is basically how prices move over a certain period of time. So there are only 6 trade setups that you need to know. On this particular day, and this was yesterday, Tuesday, my trading zone, which I calculate, this is how I look at where prices are likely to trade. And I use numbers derived from Taylor's trading technique, which is a measurement of how far prices move each day from lows to highs, from highs to higher, and from lows to lows, and from lows to lowers. And it's an average of several days, and it's an average of those averages. So there are 12 calculations that go into it. It sounds simple. It's really not simple, but it basically comes down to an area where the market is likely to trade. And typically, market doesn't always trade within the area. Generally, it does. More importantly, it gives me 3 pieces of information. It gives me a support number, a resistance number, and it gives me a range between the two. And very, very often what happens, as you can see yesterday, prices are limited or find targets right at the support or resistance number of the calculated forecast. So that's one method that I use to trade the little picture along with the 6 trade setups that I teach. For instance, this is a time and price trade. You see right in here is a time and price trade. This was a trade. This was the first leg, equilibrium. This was the second leg, where the second leg is the trade, and the first leg and the equilibrium determine the likely move for prices, which they did down to my target area at support at 38.50. At any rate, again, today is a Federal Reserve report day on interest rates. It's going to move the market at 2 o'clock. Be very careful. I'm going to show you my trading zone for today, folks, because this is where prices are likely to trade. You'll notice they're trending up for the day. The black line is the close of Tuesday right here. This is the gap where the market, let's see, it's right just before the market open. It's about 10 after 9 Eastern time, and the market is poised to open. It is likely to close the gap at some point today. At 2 o'clock, if you're conservative, stay out of the market. Otherwise, enjoy the ride. But really be careful at 2 o'clock because the market does unexpected things on normal days, and today is anything but normal, being that it's a Federal Reserve announcement. This is Marv Eisen. It's September 21st. It's a Wednesday. Have a great day. Trade safely. Use lots of patience. Thanks so much for watching, and I'll see you in my next video.